All right, so let's take a look at chapter 12. We talked about stocks in chapter 11. Now we're going to jump into chapter 12. In chapter 12, now we're going to talk about bonds. So bonds are a little different. So in chapter 11, we talked about stocks, which is equity financing. Basically, when you take a look at it, you go a little deeper. It's basically equity financing, giving us cash in by selling a portion of our company. Now, bonds is a little different. This is now basically a debt. So we are making a agreement with somebody, and somebody decides to purchase our bond, that we will pay them interest for the length of time that ever this bond is. Maybe it's a 5-year bond. We'll pay interest on that bond, and then at the end of it, we will pay the whole everything back. On top of that, all the interest that you made there. So that's what the bond does. So there's two ways of basically financing a lot of things, which is equity and then debt. Now we're going to talk about the debt side. All right, so let's take a look here in a moment. I'm just having problems here. So the first thing, we'll compute the potential impact of long-term borrowing on earnings per share. So what does that mean to that? And then we just talked about earnings per share. And then describe the characteristics of terminology of bonds payable and what that means. And then we're going to journalize it. So that stuff. And then we'll do also the installment notes as a part of that. And then describe and illustrate the reporting of long-term liabilities, including bonds and notes payable, and what that does. There's goods and bads about both of these. And describe and illustrate how the number of times interest charges are earned is used to evaluate a company's financial condition. What does that basically mean? So how much we paid in interest and those type of things there. And we'll take a look at all that stuff. All right, so first thing, the impact on earnings per share. Well, corporations finance their operations using the following sources, kind of like I talked about there. Short-term debt they may use. Sometimes you'll use a little bit if you want to do short-term. I talked about the long-term stuff. But the short-term debt by purchasing goods or services on accounts. That's one of the ways we do that. That's how we can finance things. Long-term, so that issuing bonds or notes payable. So we're making that commitment debt-wise. And then we have equity, which is issuing common or preferred stock, which we talked about in chapter 11. So a bond is a form of interest-bearing note, kind of like I described just a couple of minutes ago. So like a bond requires periodic interest payments, and the face amount must be repaid at maturity date. We must pay that whole amount. So it's a $5 million bond over 5 years. I'm going to pay $5 million. I'm going to pay a percentage of that, the interest along the way. So in here, it's considering the following plans to issue debt and equity. So they have different plans, and this is what we're looking at as a company. How do we want to raise capital? Because we need money. We need money to be able to expand our business. So we're looking at different options here. So they have 3 plans here. First plan is straight stock. We're just going to issue out a bunch of stock out here. That's what we'll do, sell part of our company. The second here is doing, that was just common, now doing a preferred and common stock splits. Remember, this probably gives us a dividend that we owe. And then thirdly, doing a combination deal here. So 25%, so basically 50% stock, the other 50% debt. And so there's different ways of doing that. But what does this all mean? Well, we still get all the same amounts, but it means different things to different areas. And so as we take a look at that, we'll take a look at these things. And so we're going to first take a look at earnings per share. What does that mean to earnings per share? Well, remember, this is what we looked at in chapter 11. We just took a look at that there. So now we're going to look at what it means to all of those, each of those ones we did. So assuming this is the corporation's interest, earnings before interest and income taxes are $800,000. They're the 40% tax rate. So that's what they got to pay as the tax bracket is 40%. That's the good stuff. And then you have the pay the dividends, the owner's dividend pay. Then all bonds and stocks are issued at their face value par value. So we're just going to make it simple. All right, so we're going to take a look at this one on this next slide. So in here, if you look in your book, you can probably follow along and see all this. And this is the breakdown of what this looks like. And so as you look at this, you'll see here the bond. You'll see all the stuff that we saw, the totals on the top portion of that. And then we're going to look at our earnings before interest and income tax. Well, one of the things about paying the bonds, or doing the bonds, is that we lower some of that. This is on page 543. we lower what we owe a little bit because we can deduct our interest on bonds. So it lowers my income, therefore lowering my income tax. And so that's some of the difference there. And my earnings per share on common stock seems a lot higher, doesn't it? Because I didn't issue all that extra stock out there as much. I had to issue a little bit more, but not as much. So my earnings per share is a lot better. And my income is lower because I get to write off some of that. Now, there's negatives to do that too, because if I do that, then what's my leverage? How much debt do I have out there versus my assets? So those are other things I have to look at also, not just the earnings per share number. I mean, that's important to look at too. There's a lot of other things that we must look at. So, but what happens too though is what happens if we don't make as much money? That does change too. So it depends, we gotta figure out how much money we're gonna make. So let's take a look at another example here. So that's the highest earnings per share, which is splitting it 50-50, basically debt and equity. On this one here, it goes the other way. Same setup. The problem is we didn't make as much money. So without making as much money, this is lower. So we got to figure out, well, how much money are we going to make? We got to make a pretty good estimate to make this work. And so that's what this is showing us here. Now is going the other way. My earnings per share is actually lower because I did the debt financing with the equity financing. So the highest there is the first one, which is common stock. And the reason being, especially for that, is they probably had a dividend in the preferred. So questions on how that works? Obviously, you have to try to figure out what you're going to make. And then, so those are the things that you do as a vice president of finance of a company is, what are we going to do? How are we going to finance some of the things that we want to do growth-wise? All right, so the next thing we're going to look at here is basically, actually, let me have you guys.
Really quick, if you do a bond, won't it increase your liabilities also?
Yes. So it will increase your liabilities.
Which will also affect your net income.
Well, it affects my net income here because I get to deduct some of that interest.
Okay.
So that's where we're taking that away here. Now, but it affects my liabilities versus my assets. And I take a look at that, and so there's only so much that people will be willing to lend us, because if we get too far to the other side, there's so much more liabilities, we're in a little trouble then versus our assets. So, all right, let's take a look at a problem here. I want you to turn to page 544 in your textbook. You're going to see a kind of an example of this, except with just two plans. So you see a plan there with just issuing equity, and then you have a plan there with a combination, equity and a bond. And so what I want you to do is just take a look at that problem, and then we're going to actually work on one that's in the book at the end of the chapter on page 567. So on 567, you'll see at the bottom of the page, PE 12-1A. And we're going to do that problem.
You didn't say 5-12.
I said 5 again. I did chapter 5 this morning, so I apologize. I meant 12-1A. See, it's late evenings. I don't know what's going on with me. I know. I don't know what's going on. At least you won't have to deal with that with me anymore.
Don't we have you the next 7 weeks?
No.
Really?
No, it's.
You'll have Dr. Sweet probably.
Who was it?
Dr. Sweet.
Oh, I guess the same was
No.
I know, I was thinking, well, why can't we just put out the final and do it
Oh.
week?
We can all do it.
No, Dr. Sweet's good. She's really good. She's been teaching managerial accounting for a long time. She'll have it all there for
That's
you.
a guy though, isn't it?
What's that?
No, maybe not. Maybe that's the communications class.
Yeah, the communications classes. So that's the problem what you guys to work on there. Okay. go ahead and start writing it up here. It's gonna take me a little time, because it's pretty lengthy, just writing everything. Use that example, that'll help me walk you through it. What's up? Okay. All right, questions on this so far? What do you got out of this here?
40, or
Is
does
that-
it say 844?
840, right here?
Okay.
Yeah, it's 840. There's a comma, that's a comma. There's a comma right there.
So I just want to make sure we understood the same.
So to get this here, we took 6% of the 6 million, because that was the total debt financing there. This one was 6% of the 5 million. And then your income tax, remember, is a 40%, so we take 40% of each of these to get this number here. And that gives us our net income. And then we have our dividends.
You divide by the amount of shares, right?
Yes. Keep. This is 504.
Same place.
So what do we do? This is stock outstanding. I'm just putting stock out. I have no room. I want to try to make sure I get it in video.
How did you get the preferred stock?
What's up?
The preferred, oh, there it says 300,000, okay.
Yeah, they gave it to you
Or
there.
300.
little confused there?
Yeah.
So they give you, basically what you're getting here from that is it says 3 million, right? So if we divide 3 million by 30, it gives us how many shares of stock we have, right?
Okay.
So that gives us 100,000,
Mm-hmm.
and then we multiply it by the 3 for how much we're going to give out there.
Okay.
Yeah. I mean, you can do it simpler than I just did it, but that'll make it easier for all the problems if you do it that way. So that's where you get the 300,000 here. And so because of that, obviously this is a little better for earnings per share, taking this one here. A little more debt financing there. Yeah, as I'm going through this chapter 12 and when I went over chapter 11, I didn't go over all the problems there. There will be also a video out there that has a lot of the problems that I have not covered today. So, and a repeat of some of these here. You'll see another video out there with some of those. So if you need some additional help, don't be afraid to look out there because you will see some things that you've already seen before. Some of you. We doing okay? Okay for me to move forward a little bit on the slides? All right. So next thing I want to take a look at here is what are the characteristics of terminology of bonds payable. What does it basically mean? What do we see here? All those type of things. So you're going to see this word a few times here. So the online contract between the company issuing bonds and the bondholder is called a bond indenture. So usually the face amount of the bond is called the principal. So it's usually in multiples of 1,000. So it's pretty simple on that. And then and it may be payable annually, semi-annually, quarterly, and most pay interest semi-annually is usually how it works. But you can see it as a variety of different ways. When all bonds of the issue mature at the same time, they're called term bonds. So you may have a bunch of them that you put out there to their term bonds. And then you have over several different dates or serial bonds. And what they call that is because of over time, different times they may come up. And a lot of companies may spread them out because you don't want to have to pay a lot of all the debts at once maybe. So that's maybe what they use serial. But if it's not too many, they feel comfortable with that, they may just do a term bond.
When it says issue,
They're just maturing at the same time. So 5 years from now, we may issue 20 bonds. Right now, we issue 20 bonds, and 5 years from now, they'll mature all at the same time.
but I guess what I think of issue is like you're issuing stock, but bonds is not like you're taking out a loan.
It is, but we're basically putting it out on the market for people to purchase the bonds. So it's
Okay,
similar.
so
It's a
okay.
debt. But that's why they say issue bonds. So you put it out on the market, and sometimes big, mutual funds and different things purchase bonds as that because they usually get a higher interest rate than you may see like in your treasury bills and that type of stuff because there's a little more risk because we're talking about companies here. Now they have different ratings for that. We'll talk about that. I think it comes up a little bit in the chapter here. We'll talk about the ratings and what that means, and that the higher the rating, the less risk it is, typically. But sometimes it goes the other way on us, and we don't realize that. The other thing is you may have a convertible bond. And what a convertible bond is basically this. If I purchase this bond, and at some point I may want to convert that into stock. You have the option to be able to do that. And so there's options that they set aside there. And so usually you don't get as much interest on that. It's usually you pay a little more premium to get that option, because if you see that our stock price has gone up considerably, I might want to convert that into their stock. So those are some things that can happen too. And then there's also callable bonds. Now callable means is that I can call it back in anytime I'm ready to call it back in. So if I said today, I'm going to issue a 5-year bond, and in 5 years I'm going to pay that mature date, when it matures, I would do that. But if it's a callable bond, a year from now I can go, you know what, I want to call that bond back in. I have to pay that face amount, but I'm not going to pay any more of the interest for the next 4 years after that.
Okay.
So that's what that means. There's no payment. I can call that in. I just pay it off. I pay my debt, the interest. I just pay up to that point, done. Just like you guys do a mortgage kind of deal. But I have that option of being able to pay it early. So that's what a callable bond means. So bonds issued on the basis of general credit of the corporation is called a debenture bond. So it's usually on the general credits of the company. So it's not tied to the specific assets. And that's what it is, general credit. This is what the company is. And that's a debenture bond. A corporation that receives the bonds depend on the face amount of the bonds, which is the amount due at the maturity date. The interest rate on the bonds, so that matters, because what you're going to be paid out every year. The market rate of interest on similar bonds. That's something that you have to look at too, because sometimes I decide to issue this bond today, and you might be picking up this bond 3 months from now, and the interest rate may have dropped. So now this bond is a lot better. Mine is, because the interest rates are going to give you a little higher. So it may be a little better. Or maybe the interest rate shot up, and mine now is not as good. So I would have to give you a discount on it to purchase my bond, or premium, depending on which way it went. So the face amount and the interest rate on the bonds are identified in the bond indenture. So it's just basically, this is what we're writing, we're putting out there in the market. Hopefully people will purchase those. The interest rate to be paid on the face amount of the bond is called the contract rate or a coupon rate. And so you'll see that coupon and contract rate, you'll see the coupon rate out there, you'll hear that term. And the reason it's stated that, and I don't think we ever go over that here, but it's stated that way because they actually used to have coupons that you'd have, and that's what they would pay the interest to you on. So it was actually a coupon. That's why they call it coupon rate back in the day. So the market rate of interest, or the effective rate of interest, is determined by transactions between buyers and sellers of similar bonds. So that's what basically is out there. And a lot of it can be because of the interest rate that's out there. So the market rate of interest is affected by a variety of factors, including investors' expectations of the current and future economic conditions, how that's going to be. So, and a lot of it depends on supply and demand, again, because if they think that the stock market may go up, they may not buy as many of the bonds. They may move their money more into stocks. If they think it's going to go down, they may move it more into bonds, which is a little safer, and they don't have to. So it is a lot of that too. And so that may affect the interest rates on the bonds. All right. So this is a diagram here, just showing some information about what it is. So $1,000 equals the $1,000 bond. That's sold at face value, with the face amount. In here, if the selling price is less than the face amount, it is sold at a discount. Well, makes sense, right? We're selling at a discount because they're paying less than it should cost for that. And then vice versa, going the other way, they're paying a premium. Remember I said that when we talked in chapter 11 about stocks. All right. So let me summarize all that crazy stuff I just went over. If the market rate equals the contract rate, bonds will sell at the face amount. Then if it sells less than the face amount, then we're selling at a discount. And then vice versa, it's selling at a premium if we sell above that. All right. So the price of a bond is quoted as a percentage of the bond's face value. So you'll see it as 98 or 102. That means that's a percentage of that. So when you see this here, this is 98, so it's $980. That's what you'll see out there sometimes. So that's what we'll work on here. And so in here, this one's a little bit more than that. It's 109, so which is is 109%. It's $190. Or excuse me, $1,090. So that's how you'll see it in the terms there. Questions on how all that works? So we'll work on some problems with all this stuff in just a few moments. We're getting into that. Actually, let me have you, I think it's this one in this one here. Let me go over a few more, and we'll go over the problem here. All right, so journalizing entries for bonds payable. Now we're going to take a look at discounts and premiums and journalizing all this stuff, and then we'll do a problem on that. So on here, January 1st, 2013, Eastern Montana Communications issued the following bond here. So they're going to give a 12% interest. They're going to pay it semi-annually. So that means they're going to make 10 payments over the year, over the time frame. So because there's 2 per year, 5 years, and the market rate of interest is the exact same as our contract. So there's no premium or discount on this one. So in here, we have cash. We get in $100,000 because we made this commitment to pay this bonds payable of $100,000. So we have all this debt. Now this does not include the interest in this yet. Okay, this is just the transaction of the bond going. Somebody purchasing the bond, and I get the cash in from the company. Then we have the first payments of interest is due. And so what we have here, since we purchased it perfectly at January, I think we did it on January 1st, right? So it happens after 6 months, I'm going to pay basically 6% because the whole year we pay 12, and I'm taking half of that we pay now because it's 6 out of 12 months. So we're paying half of that now. So I'm paying $6,000 interest here for 6 months of interest. And then in December, well, this is at the end of it. We would then pay out the cash that we owe. So we would pay out the bonds payable, and we would lower our cash. And all the transactions, it skipped a lot of them. We'd have every 6 months we would pay the interest on that. So as you can see, we paid over the time frame quite a bit. We would pay about $60,000 in interest. All right, so on January 1st, 2013, Western Wyoming Distribution issued a $100,000, 12% 5-year bond, and the market rate was 13. So you see that difference there. Well, why is somebody going to buy my bond when they can purchase this bond and get some a little bit of percentage? And so interest will be paid on these dates again, so exactly 6 months will come up and we'll have to pay that. So the bond will sell at a discount when the market rate of interest is higher than the contract rate. Remember that. So because you get somebody to buy mine, because I'm not going to pay them as much, I got to offer a little discount for that. So that's what we're going to do here. So in here, we're going to give them a little discount. So we have cash, get the discount, and then this is the bonds payable here.
How did they come up with that?
I think they just gave it to us.
Oh, okay.
I think they just gave it to us on that.
Right, that's exactly what I was doing. That's not.
Yeah, it's not perfect. So I think they just gave us a discount on it.
Okay.
They gave all that to us. And your problem, I think, gives you the same thing. So you won't see any.
Okay, so it's not like a
Yeah. No, not usually, no.
Okay.
So a discount may be viewed as the amount required by the investor to accept a bond rate of less than the market value. So yeah, I'm going to purchase it at this, then I'm going to get less interest over the time. So I'm making up for it when I purchase it. I'm going to get a little bit extra from that. That's what you're going to get. Make sense? All right, so there are 2 methods of computing the amortization of a bond discount. So we're going to amortize that over the time though. So because looked like we got about 3,000 off, something like that. So there's a straight line method, which we talked about in previous chapters. I think that was chapter 8, something like that. And then we have effective interest rate method, which is sometimes called the interest method. We'll take a look at what that means here. And then both methods amortize the same total amount over the life of the bonds. So it just depends on the percentage we're using that or just a straight line. So the effective interest rate method is required by GAAP. But maybe maybe use in the results, but do not differ too much from that. Straight line obviously is a lot easier, real simple, divide by how many years, and boom, it's done. All right, so here's the interest here. So this is the, what's happening here is this. So as a company on that, I had a discount on bonds payable. And so since that one, remember that was a debit? Remember that? Now I'm going to credit it. And I'm going to start to break that down. And basically they're doing it, taking 1/10 of that, because there's 10 payments. So I'm basically dividing it by 10. And that's going to be what my discount will bring it over the time. So that's my interest expense is here. It's a little higher, my interest expense, than I'm actually paying. And so I get to write off a little more over with my net income because of that. Because I didn't get them to buy it, I had to do that. I had to offer that discount. So I'm going to amortize it over the next 5 years. Questions on that? Remember, it's 10 because we have 2 payments a year times 5. That's what we get with the 10. That's how we get that. And then we'll have that next one. All right, so bonds issued at a premium. So on January 1st, Northern Idaho Transportation Inc. issued $100,000 for 12% 5-year bond. Market rate is 11. So now we're offering a lot better than the rate is out there. So now we're going to sell it for more. So now we're going to go the other way around. So now we have a premium on bonds payable. So that's a credit. And we will debit it, amortize that over the time, similar to what we just did before. And so, because the contract rate is less than the market rate is less than the contract rate. Here, similar thing. We will take our value here and then basically divide that by, so we just show that, sorry. Well, we'll divide that by 10. So, and that's what we come up with there. And we'll take it away from my interest expense because they paid me a little extra for it. So questions on how that's working? All right, so a corporation, like I said, they call them in because they have that option that if they set forth that, they put that in the bonds. They can call that in and be redeemed by issuing corporation within the period of time and stated in the bond interest. So there must be a time set in there where they can call that in. Normally, the call price is above that face value. So they may go above that to call it in. So the carry amount of the bonds payable is the face amount of the bonds less any unamortized discount or plus any unamortized premium. So let's take a look at what all that means. That's a little confusing there. So a gain or loss may be realized in the bond redemption as follows. So we may have a gain or loss on that over the time because we may pay a discount or a premium, so we have not amortized that over the whole time yet. So a gain is recorded if the price paid for the redemption is below the bond carrying amount. So remember that, we're gaining if the purchase is below it, we never got back up to it. And then vice versa, loss is recorded if the paid for the redemption is above the carried amount. So in here, a corporation has issued a $100,000 outstanding bond on which there is an unamortized premium of $4,000. The corporation redeems 1/4 of the bond for $24,000. So what happens here is that we have that premium of bonds payable. We are going to go ahead and take care of that 1,000 because that's 1/4 of that. So we have the 25,000 here because that's what the bonds payable was. But we only got $24,000 cash in on that. So we lost 1,000 because of the premium on that. Plus we lost an extra 1,000 here because we got less money. We only got 24,000 to 25. So here we have a gain, actually a gain on this. I'm sorry. So we have a gain because we had a premium on that. We got. We only had to pay off 24,000, which is nice. And that would go in your other income. way back when we were studying the income statements. You don't put that in normal operations. All right, so the corporation calls the remaining 75,000 of it, but now they have to pay a private investor a little more money for this one. So 79,500. So we have to pay a little bit more, so that's how much cash outlay there is here. We have that 3,000 still left over in that bond premium because we took 1,000 from the previous. So we have 3,000 left, and then we have 1,500 that we have lost because we have to figure out what the loss is to get to this amount here. So we have 75,000. 3,000, 1,500. And this was the other loss section. All right. Questions so far? Let's go over one real quick. I want us to do, I want you to turn to page 547. And we're just going to do a real simple one here, issuing bonds at a discount. You can see there's an example here of issuing a bond. They're going to do it at a discount because the market rate's a little better. Well, they give us the discount and all that stuff there. So we're going to receive the cash in for that. So that's, you just do a journal entry on that one. So I want you to do a problem, 547 is your example. On page 568 is the problem, which is 12-2A. And I said 12 this time. Get better. 2A? 2A. An example on page 547 is very similar to this one, so use that to help you journalize this transaction. They give you all the information, so it's now just doing a simple journal entry here. There's no calculations really. Thank you. All right, so questions on that? Pretty simple. Not too hard. You see probably a simple question like that on the homework. All right, so let's take a look here at describing and illustrating the accounting for installment notes. So sometimes we decide to do installment plans, you know, they basically you may go to a lender or somebody else to get this. So an installment note is a debt that requires the borrower to make equal periodic payments, okay, like we would do with a loan or something like that we would have. Where bonds a little different, where we just pay the interest until the face amount is due. So this is a little different. So the payment of a portion of the is a principal, like we would do for a car loan, and then another portion of that would be interest on the outstanding balance, like in a car loan or something like that. So installment notes are often used to purchase specific assets, like a car or a building or something like that. And so, and it's usually secured to that asset. And so that's what your notes payable you'll see is that. So it is also sometimes called a mortgage note. You know, we know about those because that's what we have. A lot of us may have a mortgage that we have is tied to that house that we have. If the borrower fails to pay a mortgage note, the lender has the right to take possession of that pledged asset. So that's some of the things that can happen, that happened, especially in the 2008, 2009 time, is when we weren't able to pay those, a lot of lenders came in and took possession of those assets. So Lewis Company issues $24,000 6% 5-year note to this to City National Bank. And the annual payment is $5,698. So we get cash in for that with the commitment to pay that liability of $24,000. So that's a transaction that's happened there. Now we're going to walk through some installment notes in just a few moments here, but so this is just a basic transaction there. In here is the breakdown of what's being paid and what's happening here. And so in intermediate accounting too, you'll go over a lot more of this area also. But basically we're breaking down this. We have your beginning, this is our interest paid here, and then this is our decrease in notes payable, so this is our carrying amount. We will then take the 6% times that amount to get my value here for the notes and the carrying amount there. And then we'll continue doing that all the way through in here for the interest as a part of that. Because my interest will be going down a little bit as time goes along because we have less that we owe on that principal. But they've already figured that out all the way to that point, so how much more we pay in interest. And that's why the value works out the way it does. Because these payments, we already know now it will be in the end how much it will be. So you get that. That's the payment that we have. So that means I take this minus this is that. There. And then we take that minus this will give me this one. You can see the letters there. It kind of tells you there. So hopefully you see that. And that's also in your book. So I'd say minus D equals that. And then you'll take that over to here for the next year's carrying amount to start over. It'll be the same trend of stuff again. All right, so let's journalize this transaction here. We have our interest expense here, and then we have our notes payable because we're paying down that note. So we owe less than that note what we saw there before. So our cash still is the outlay for the whole amount, but we have now interest expense of this. My interest expense will continue to move down as you saw in the previous slide, and it will slowly decrease, and my notes payable amount that I'll be paying towards it will go up. Kind of like we see it in our with a vehicle or something like that. It's similar pricing to a vehicle and the way it's built too. And so the next year, as you can see, the change. This is the setup here. You'll see this go up, this go down. See how this rose up? Those people, that more portion goes towards it each time. And then you'll see by the end, this is the last one. Most of it is principal, interest, is a lot lower. Questions so far? All right. Now your note is 0 by the end of this, so I don't know anybody more than I do this family. All right. Questions on objective 4 there? Pretty good. All right. Let's move this objective 5 here. So we describe and illustrate the reporting of long-term liabilities, including bonds and notes payable. So as you can see, this is what a balance sheet looks like here, and you can see our current portion of our notes payable. And then this is our long-term, right here is our notes payable. Yeah, that's the wrong one, sorry. The notes payable here is what we owe long-term wise. So we have $200,000, that's our current portion within the year, and then this is outside that year is the rest of the year. Okay, so those are our long-term liabilities. That was a quick section there. So now we're going to take a look at how many times interest charges are earned is used to evaluate the company's financial condition. So basically how much we're paying interest versus our income and stuff like that. So I'll let you read through this here. Give you a moment. So basically, it's the risk of the bondholders. And this is what they use for the ratings too. So I'll give you a moment to kind of get that down and kind of get an idea of what that is. So here is the formula to figure that out. It's your income before income tax and interest expense over interest expense. So basically, I'm taking my income before I pay the taxes, and then adding my interest expense, and then dividing by my interest expense. So how much times am I discharged? And what that kind of tells me is, exactly what they were saying above is basically the risk bondholders are going to be paying on. So that's what we're kind of looking at here. And so we will compare these against other companies too. And that's kind of some of the things that they use for ratings. There's a lot of other things they use for ratings too. Taking a look at your assets and liabilities that you have out there, which would have you done in the past. So let's take a look at a problem here. I'll leave this up here for you to take a look at. So let's take a look at a problem 12-8. A, which is on page 569. And a good example of that one is on page 556. You got it ready?
Well, for the first 116. Oops.
All right, I'll give you guys a moment to take a look at that. So look at the practice problem. That's going to help you out a little bit, and then we'll work it through together in just a few moments. Easy to figure out. You okay there? So we're just taking our income before taxes plus our interest expense and divided by net interest expense. Now looking at this is a decrease. It's still a pretty good amount. I mean, you still have quite a bit there. There's some cushion there, but I would be a little worried as a debt holder, they're heading the wrong direction. So that's some of the things I would look at as a risk. So that was the second part of the question. So analyze, we're going back actually down the other way. So that's not a positive trend. So I would take a look at that one. All right, so questions?
That's not positive? You want it to be a higher number?
Yeah, you want to be the higher number here. So if this number was a lot less, it would be a lot higher. Your interest expense, you want your interest expense lower. So interest expense being lower, then this number would be higher.
Okay, because I was thinking it was good because it was a smaller number. I thought that 11 was better than 13.
No, you want more. Yeah, you want it better.
Okay.
Yeah, that's a negative. They go the other way. So yeah, because if you have this about 200,000, you'd have a higher number, and we'd be paying less interest, which is a little better in that way. Risk for our bondholders. So questions on chapter 12. I kind of went through chapter 12. too much stuff that was too complicated in there, but I'm sure you have some questions. There will be also some videos on the problems too that are out there.